Hello everyone, this is Tyler coming to you from Securities Investments. Today it's January 27th and I'm going to talk to you guys about what is shorting a stock. This is a common day trader technique that many people use in this community, but there's many people outside of day trading that don't know what shorting a stock is. So shorting a stock has been a very popular technique now for many years. And for speculators, gamblers, day traders, hedge funds, and other kind of investors that want to take on a substantial risk of major gain, but also major loss. And many people argue that shorting is actually more risky than even buying a stock. And shorting a stock is, it involves the sale of a stock that the seller does not own, or shares that the seller has taken on as a loan from the banker or the brokerage, and traders then sell these. Now, the motivation of shorting a stock is there's many, but short sellers take these transactions believing that the stock price is evidently going downwards, and if they sell the stock today, they'll be able to buy the stock back at the lower price in the future. And evidently, if they accomplish this, they'll make a major profit, which consists of the difference between their selling price and buying price. So some traders will mostly short for speculative purposes, while others want to hedge, protect, or reduce a long position. And if they already own shares of the same, or if they already own shares of this company. So just to kind of give an example here so people understand better, is that suppose you believe that the stock price of General Electric is overpriced or overvalued, and the stock is going to crash sometime soon. You believe it so strongly, of such a large conviction, that you decide to borrow 10 shares of General Electric stock from your broker and sell the shares with the hope that you can later repurchase them at a lower price, return them to the broker, and pocket the difference. Now, one disclaimer here though. Often people think of stuff in very literal sense, and in shorting, it's often better to think of it in a more figurative sense, because when all of this is going on behind the scenes with the brokerage, it's not necessarily, it's being presented in a like a visual format so people understand this isn't necessarily what's going on behind the scenes. Just so you're aware, when you short with Charles Schwab or with E-Trade, Ameritrade, what's actually going on may not be how it's being showcase this way. This is a way to help people understand. Okay, so so going back to this situation is that you proceed to sell the 10 borrowed shares at $50 a piece and pocketing $500 in cash. In reality, you would pay a small commission, and depending on timing, may also have to pay dividends to the buyer of the shares. But these are omitted in the example for simplicity. So you now have $500 in cash and have an obligation at some point in the future to purchase and return the 10 shares of this General Electric stock. If the stock goes up above the $50 price, you'll lose money because you have to pay a higher price to repurchase the shares and return them back to the broker's account. And there's a very famous example. This is many decades ago. This was in 1901, when day trading was much less known, or even stock trading. There was a well-known stock called Pacific North Corner, and there were many very wealthy men that had shorted this stock at this time. And what happened is, in a single day, it went from 170 a share to 1,000. At this time, some of the wealthiest men in America actually had bought this, or had shorted this stock, so that it actually bankrupted these guys. And There's been other more recent examples of this happening. Now, as was stated before, you have to be aware of the risk when shorting a stock, because when you short a stock, you expose yourself to a very large financial risk, often much larger than even a stock that you're betting will go up. Because a stock could, if you're short, a stock could go up 300%, 1,000%. So that would be 300% or 1,000 multiple of say, if you bought like 100 shares of a stock and then it went down. In this case, if you're shorting and it goes up, if it goes up a few 100%, then it's a multiplier of 3. In some cases, when investors and traders see that a stock has a large short interest, there's a big percentage of the shares that have been shorted. They'll often kind of get on the bandwagon, and this is probably the best time for a retail investor to get on board and maybe try and make some money from this. But one thing to know is that you should never leave shorts open positions overnight, especially if you're a retail investor and you don't have a lot of funds. Also note that there's often a limited number of shares that can be shorted per company. So even though there may be 1,000 people that want to short a stock, there may only be 100 people that can, because there's only X amount of shares available. Unlike when you buy stock, there's not usually this limit on how many stocks can be sold for it to go up. So that's very important to note. And for any new investor or day trader, my recommendation is avoid shorting and learn the ropes. And there's plenty of opportunities to buy stocks with the mindset that they're going to go up. And also remember that the natural state of the stock market is positive trends, and especially with NYSE and NASDAQ and S&P. So this is a huge gamble to short. Hopefully you learned something new here, and thank you.